Okay, if you're a founder, you know that every single dollar of your capital is all about momentum. But what happens when a financial product that's sold as safe, like an annuity, has these hidden drags that could actually shorten your company's runway? Well, in this explainer, we're going to pull back the curtain on the hidden costs in annuities that can quietly and seriously derail your plans.
And you can totally see why, right? As this quote says, annuities are basically sold as the financial equivalent of a calm, steady sea for your money. They come with these glossy charts and smooth sales talk promising predictable, stable returns. It all sounds so safe.
Because what if, just beneath that serene surface, there are these powerful undercurrents, hidden forces that can slowly and silently eat away at your returns? Most people, they never see them coming until it's way too late. So let's dive in and see what's really going on under the hood.
All right, Section 1, the annuity's calm facade. We're going to look at what's really lying beneath those comforting promises of stability.
So, we're going to investigate three main culprits here: currency risk, FX fees, and cross-border taxes. Now, these are the things that rarely, if ever, get brought up in the sales pitch. But believe me, they have the power to seriously shorten that financial runway you're counting on.
So, our first hidden threat is currency risk. Think of it as the shifting foundation of your investment. You might think your annuity is a totally safe domestic product, but you'd be surprised how much global market forces can shake things up.
At its core, currency risk is pretty simple. It's just the chance that a shift in exchange rates is going to reduce the value of your investment. But for an annuity, this isn't about the number of dollars you get back. It's about what those dollars can actually buy in the real world. That's the key.
And you might be sitting there thinking, hang on, how does this even affect my annuity? It's all in dollars, right? Well, here's the thing. The insurance companies, they often invest in international assets, bonds, other vehicles, to back the payouts they've promised you. So even though you get paid in good old US dollars, the financial engine that's powering that payout, it might be running on euros or yen or other currencies you don't even know are involved.
And this right here, this is where the real danger lies. You see, a small currency dip, maybe 1 or 2% in a single year, you barely even notice it. But annuities are long-term products. And over 10, 15, or even 20 years, that tiny, consistent drag, it compounds into a massive gap between the financial future you were promised and the one you actually get.
And this is exactly why it matters so much for founders. That stable runway you were planning on, the one you were going to use for hiring, for R&D, for managing your burn rate, well, it can end up being a whole lot shorter and way more fragile than you ever thought, all because of some currency movements happening thousands of miles away.
Okay, next up is our second hidden threat: FX fees. This is the silent drain on your capital. Now, this isn't about unpredictable market swings. This is about costs that are baked directly into the financial plumbing of the annuity itself.
And that's called the FX spread. Anytime your money is converted from one currency to another, there's a fee. But here's the tricky part. It's not a line item on your statement. Oh no, it's hidden inside the math. The rate you get is just a little bit worse than the real market rate. And that tiny difference, that's their fee.
And that's the crucial part. Unlike market risk, which can go up or down, these fees are a persistent, one-way drain on your capital. They're charged on every single conversion, just steadily siphoning value away. And it doesn't matter if your investment is performing well or not.
And what's really wild here is that it's not just one fee. Your money can get hit multiple times. It's like a gauntlet. First, there's a fee when you buy in. Then, potentially another fee if the fund rebalances its assets internally. And finally, a third fee when you get your payout. At each step, another little slice gets taken out.
So let's be crystal clear about this. FX volatility and FX fees are two totally different problems. You can't control the market swinging up and down. That's just the reality of investing. But you can control your exposure to fees by really understanding the structure of the product you're buying and choosing one that keeps these hidden costs to an absolute minimum.
Okay, our third and final hidden threat: taxes. This is the surprise trapdoor in your plan. And for founders who are really relying on predictable cash flow, this can be the most jarring surprise of them all. So let me introduce you to the withholding tax. When your annuity has a cross-border piece to it, a foreign government can literally tax your income at the source. This means they take their cut before the money is even sent to you. You just end up seeing a smaller payout, often with no real explanation as to why.
And it gets worse. You could actually end up facing double taxation. Yep, you pay that withholding tax in a foreign country, and then you still owe taxes on that very same income back home.
Now, tax treaties are supposed to prevent this, but they don't always work perfectly, leaving you to pay twice on the same dollar. It's a nightmare.
For a founder, an unexpected tax bill this big isn't just a cost. It's a massive shock to the system. The source material describes it perfectly as a trapdoor. One minute, you're confidently striding forward, planning your next hire or expansion, and the next, the floor just opens up from under you, throwing your whole growth strategy off course. Okay, so we've laid out all the threats. Now I know that might sound a little scary, but here comes the good part. This is your protection playbook. The goal here isn't to scare you away from annuities, not at all. It's to help you shift from being a passive buyer to a proactive investor who is firmly in control.
And the key to this entire thing is just one word: clarity. True financial protection doesn't come from a product's fancy marketing promise. It comes from deeply understanding how that product is actually built. It's all about asking the right questions before you sign to prevent some really painful surprises after.
So here it is. This is your playbook, your pre-signing checklist of the sharp questions you absolutely need to ask. These aren't the typical questions, I know, but the answers are what separate a truly safe investment from a really risky one. Getting clarity on these points is how you protect your company's future. It's how you protect your runway.
And we can boil this all down into 3 simple, actionable steps. First, map your exposure. You have to know exactly where your risks are. Second, minimize the number of conversions to stop the value from bleeding out through fees. And third, if it's at all possible, match your payout currency to your spending currency to pretty much eliminate the risk altogether.
Because at the end of the day, this is about so much more than just money. For a founder, capital is momentum. It's the fuel for speed, for innovation, for growth. By getting this financial structure right from the beginning, you're protecting your company's ability to move fast and stay ahead of the game.
So, we'll leave you with this final question to think about when it comes to your own financial plan. Is it built on a promise, or is it built on clarity? Because in the world of finance, true safety doesn't come from trust, it comes from understanding.